Okay, good morning. Nice to see everyone. We will get started in a minute. We have a bunch of folks in the waiting room. All right, let's go ahead and get started. So good morning. Welcome to today's session, Working with Family Offices as an Emerging Fund Manager, hosted by the Nasdaq Entrepreneurial Center in collaboration with IIE.VC. I'm your host. I'm Jessica Strauss-Fuchs. I'm excited to introduce our panelists for today's conversation. We have Nic Millikan, who's Managing Director of Client Solutions for Allocate. Nic, if you could wave. Neetu Parinakmath, Senior Investment Officer of the Cooper Family Office. Neetu, if you could give a wave, thank you. And finally, Winter Mead, Founder and Managing Member of Coolwater Capital. So today we are going to discuss what's top of mind for family offices, how you meet and communicate with family offices, and really dig into how family offices operate. We created this event because we know family offices play an important role, often as a first mover LP for emerging venture funds, and yet it can be hard to identify family offices and understand each of them as they're all a little bit different. So we wanted to hold this event to provide more transparency and insight into family offices, and I'm excited to get into the discussion. A few housekeeping items. First, we are recording this main session, which will be available on YouTube later. So if you want to come back and reference it, or if you need to drop, it will be recorded and available. Second, for the agenda today, we're going to spend the first 50 minutes. I will be asking our incredible panelists questions in a fireside chat, and then we will go into breakout rooms. Each of our panelists will be moderating a breakout room, and that's your chance to ask them questions. Each of our panelists is bringing a slightly different perspective on the family office industry, and so prepare your questions. I also welcome you to put your questions in the chat or ask your questions during our plenary discussion. Finally, I want to highlight our hosts, the wonderful Nasdaq Entrepreneurial Center. We have our Executive Director and CEO, Nicola Corzine. Nicola is with us in the chat. She leads an incredible organization that has its headquarters in San Francisco. For those of you in San Francisco, their beautiful spaces at First and Howard. And through both the physical space and digital classes, they have served over 75,000 individuals through workshops, classes, and events. And through their Milestone Makers and Milestone Circles initiative, have directly worked with 3,000 entrepreneurs who have gone on to raise over $880 million in capital. The Nasdaq Entrepreneurial Center, recognizing the important role that capital plays in entrepreneurial success, have also built a focus on venture capital firms, specifically supporting diverse emerging managers who are raising capital, and in doing so have stood up a number of programs, including today's event, to support emerging fund managers. And we're going to be doing a lot more over the next 2 years, so please stay in touch. Sign up for our newsletter so that you can have access to the events that we will be doing in the years ahead. I also want to acknowledge our partner IIE.VC for this event. IIE.VC is an organization partnering with the U.S. Treasury Department, and it stands for the Initiative for Inclusive Entrepreneurship, in order to enable access for emerging managers to the State Small Business Credit Initiative, known as SSBCI. That program is block granted to states, and 46 states have programs making capital available to emerging fund managers like you. There's a lot to learn about the program, and so IIE.VC is opening doors and helping folks navigate based on your state and where you are in your fundraise, how you can access those funds. I am excited to share that we have Chris Trinetti on today, who is leading the II.VC initiative. And I'm going to turn it over to Chris to just say a few words about the program before we go into our discussion.
Yeah, thanks, Jessica, and thanks to Nicola and the Nasdaq Venture Equity Project team for your partnership and leadership on this topic. Yeah, so as Jessica mentioned, IIE.VC, we're basically the venture capital arm of the Initiative for Inclusive Entrepreneurship, announced by the White House in October 2022 to support the $10 billion program called SSBCI. It's increasing access to capital for leaders like you. That is our North Star. We're trying to help $3 billion in public capital reach diverse emerging managers. And there's a one-to-one match requirement for this program. So if we're successful in not only working with states and Treasury, but also convening the private sector, and family offices are a core stakeholder of ours, this will be $6 billion in new AUM for diverse emerging managers. So with IIE.VC, we are convening the venture capital ecosystem. A lot of these groups get together for events, but never have they really come together to collaborate on this topic of increasing access to capital. And so our first order of operations is bring the ecosystem together and bring in very talented groups like the Nasdaq Venture Equity Project to enable them to take their great work to the next level. We're also spinning up a handful of solutions right now to support emerging managers. We're raising a grant pool for that would be go towards fund expenses and fund management fees. So you can spend more time sourcing and diligencing deals and doing the things that are ultimately going to earn a return on your LP's investment. We're also planning to raise our own fund so we can invest directly into emerging managers alongside states as they invest into through the SSBCI program. So I am thrilled to be, like I said, working with the team who's organizing this call, Jessica, Nicola, and Christian. And you can reach out to me directly via chat, LinkedIn. I'll send you my LinkedIn in the messaging, or also info@iie.vc for more information. But I'll turn it over to the main event here, Jessica.
Thanks, Chris. And I just put your email in the chat for those of you who have questions. You can send Chris a note, or you should all have my email by now. Please feel free to reach out directly and I can connect you. Well, great. We are ready to get started on our discussion. I'm going to start with asking each of our panelists to introduce themselves so you can learn a little bit about where they are coming from. And let's start with you, Nic.
Perfect. Great. Well, it's great to be here with you all. My name is Nic Millikan. I'm Managing Director of Client Solutions at Allocate. We're a fintech venture investing platform that really brings together a curated menu of venture GPs with LPs that we typically source from family offices and RIAs. So really helping reduce the barriers to entry and the friction that it takes for managers and GPs to meet appropriate LPs there. We have a great technology stack that I think is industry leading in and of itself. My background is really in asset allocation. I came up through my career at BlackRock. I initially worked in quantitative Australian equities, bridging the gap between our institutional clients, so sovereign wealth funds and central banks, and our quantitative portfolio management teams, and building solutions for them. I then moved to the US, moved into global bonds with BlackRock before they bought the iShares business. And I saw a real degradation of alpha in the industry in general when it came to active management. And that's where I started shifting my focus about 15 years ago into the alternative space. So I've done stints at the Getty Family Office, which spun out a mutual fund company focused on liquid alternative investments. And then I helped build the CAIA platform, which is one of the first pioneering fintech platforms focused on the democratization of alternative investments. My most recent stint was as deputy CIO at a multifamily office focused on venture and technology investing. And I joined the team at Allocate about 3 months ago, really because of the way that they're looking at solving access and transparency issues around venture capital specifically for the independent wealth management channel.
Thank you, Nic. Nitu, next.
Hi, everyone. My name is Nitu, and I grew up in the Bay Area, currently based in New York. I'm a senior investment officer leading private capital allocation and direct investments for Cooper Family Office. On the private capital side, we are aiming to grow our venture capital offerings, specifically between pre-seed and Series B. My personal background has been direct investing in technology operations. I began my career at Google, worked at various startups, also was an entrepreneur in residence for Techstars and a direct investor with Alumni Ventures Group. As a single family office, we are allocating into emerging fund managers, meaning a lot of fund ones and fund twos. And yeah, I'm excited to share a little bit more about our process.
Thank you. And thank you to Winter for inviting Nitu. We're so glad to have you. And Winter, round us out. Thank you.
Thanks, Jessica. This is a great turnout. Hi, everyone. It's good to see everyone. Feels like a Coolwater session. So Coolwater, I founded this company, CEO, founder, blah, blah, blah. We're an incubator and accelerator. The idea is to like be your most helpful partner when you're launching and scaling your investment firm. So that's not a straightforward comment, but the idea there is we run multiple programs to help you launch and scale. The core program is called Build. You know, you're ready to build your investment firm. We've helped 185 firms in the last 3 years get into business. They've raised over $2 billion. That's not us raising it for them, but you know, they're successful in their own right. We have an 83 NPS score. So, you know, it can be lonely starting a fund. We try to, you know, create this experience that's both helpful and supportive, and try to create a culture that, again, is positive for the emerging manager experience and getting into business as an emerging manager. We do have an active fund that invests into this ecosystem as of a year ago. And yeah, like, why do we do this? We think emerging managers serve as that base layer for the innovation ecosystem, right? These are the people that are writing the first checks, that are exceptionally supportive to founders, which is also a lonely journey and a tough journey. So we want to, again, support the capital markets for that piece of supporting founders. And we also think the best returns that you can see by investing into funds occur in emerging venture funds. So thank you, Jessica, for hosting, and thanks everyone for attending.
Wonderful. Thank you. We're going to start out with a question. What is top of mind for family offices investing in venture capital in 2024? And I'll just add a bit of editorial commentary. Anyone out there fundraising, you've seen that it's a tough environment. There was just a study that Venture Capital Journal put out that showing LP sentiment broadly is more negative toward venture capital this year and in the next 12 months. So there's data to corroborate LPs are, you know, really considering their venture capital exposure and maybe reducing it over the coming years. So all LPs are different. That was a survey of all LP types. I would love to start, Nic, because you are in the market speaking with various family offices all the time. What do you think is top of mind for family offices investing in venture in the coming year, next 12 months?
It's a really great question. And I think the one thing I would temper that survey that you've mentioned with, you know, in the reduction of LP interest in allocating to venture and scaling back their exposure is that people are typically under allocated to venture in general relative to where they could be. So we see allocations between 2 to 5% just in independent wealth management. So think RIAs and financial advisors. And obviously, if you look at the endowment model and where Yale is at 23, 24, 25% exposure to venture specifically, there's an underinvestment there. Obviously, they're very different investing characteristics and timeframes, but you know, there is room to grow. And that's what we're seeing. We're seeing family offices really approach the venture allocation decision in a more data-driven and programmatic way. You know, other asset classes, you know, you optimize portfolios around your public and private equity exposures as well as bonds. And venture is sort of an afterthought, or has been until now. But I think people are really starting to focus on it just because active management hasn't worked out over the last 10 years. You're getting a lot of beta from those public market exposures to equity. And the real area of alpha and defining returns are coming from things like venture capital. So I think there will be, while bigger endowments, pensions, and foundations may be scaling back their venture exposure, that's certainly not what we're seeing when it comes to family offices in general. But the thing they're tackling is, where are we in the cycle for venture capital? Obviously, it's been a rough ride for the last couple of years. And that's why we think you need to have this programmatic approach to venture where you're consistently allocating over vintages, not trying to pick the bottom. Obviously 2024 is probably a pretty good place to start getting involved in venture if you're not already, just given where we are from a valuation perspective. And so right now, we do think 2024 vintages are likely to be very attractive, but that's not the reason why you would get involved in venture today. It's just to start, taking a toehold in the space and building that out. So we do talk to people a lot about, yes, we might have been at the bottom. We may not be at the bottom. There may be further, valuation write-downs coming through the pike, but it's not, shouldn't be trying to time this market. It's not a market that's timeable. And so just helping them think through, building out a programmatic way to approach venture is where we're seeing the conversation go.
Interesting. Nitu, since you're at a family office, I'd love to hear from your perspective how you all view investing in venture.
Yeah, no, of course. So I think, one of the things that's difficult with investing in first-time and second-time funds is a track record, right? I think a lot of times that's an issue, especially when Fund 1 was raised in the bull market of 2020, 2021, and now Fund 2 is trying to be raised in the current market, and there's been a lot of down rounds. So for us, we're not really looking at strict TVPI, DPI, MOIC, or things like that. We have other ways to kind of measure the health of a portfolio and track record. We've noticed qualitatively when looking at GP teams, GPs that have significant success when they're emerging managers tend to either, be repeat founders themselves, or they've had a prolific angel investment track history, or they might have worked as a principal or partner in a larger fund and then made the decision to spin out. We typically like to see if there's a GP team, more than one GPs, that the GPs have known each other for a while and that there's some sort of trust. This can be a personal connection. It can be a professional connection. It's similar to the way I would say GPs are evaluating founder teams. When you're looking at early stage founders, you're looking for that founder market fit. We're really looking for that GP investment thesis fit. Why are these, especially when there's a proliferation of so many emerging managers, even in the current market conditions, we want to know, how is this GP team or solo GP the best person to be investing in this particular asset class and in these particular sectors? We also have opinions about generalist versus specialist funds, and we've invested in both, so we're open to both. But I think, the quantitative tracking of the portfolio and evaluation of the portfolio is one piece, but a huge reason why I travel a lot and I'm flying across the country is to meet emerging fund managers and to be able to kind of qualitatively diligence them and build that level of trust.
Thank you. That's great. So the qualitative piece mattering as much, and interesting to hear the other measures you use apart from strict financial performance. Winter, what would you say?
Yeah, so a lot of conversations with family offices this year and last year. Again, it's a vast generalization, but the three things I see family offices focusing the most on right now is yield, right? So just like, where are you going to find yield in your portfolio? And I think recently, or maybe call it, recently being like 2 years ago when money was cheap, like they found yield in venture. And now when money is more expensive, like I think family offices are starting to rethink just what their portfolio allocation is. So I think that's top of mind for family offices. Liquidity is another big one, right? Just like, people are realizing that venture is a long-term asset class, right? That's not new, but there are a lot of new family offices that jumped into venture when it was up and to the right during 2020 and 2021 and even 2022 as the fundraising market kind of carried over. into 2022. I think, now there's, in terms of exposures, I do agree with Nick. I think a lot of folks are underexposed, but right, they're kind of balancing this exposure versus liquidity. And I think some of them invested a lot and want to kind of like temper it in this recent market. Just trying to see like, okay, I got into venture, I invested a bunch. Let's see like what's happening and how this really works. So I think there's some thoughtfulness around just liquidity and how much do they want to invest consistently, over the coming years. And then lastly, I think they're thinking about like their own books, right? I've definitely heard from a subset of family offices that went into venture in a big way in 2021, and they're processing right now their existing books and saying, what is this actually valued at, right? How are these companies actually doing? And I think again, there's thoughtfulness around that topic right now in the world of family offices.
So for
I also
emerging
wanted to just kind of carry off what Winter said. I think liquidity is a big one for us as well. It's why we're playing a lot in the secondary space. And with the pre-IPO markets being what they are, we are looking for GPs that have M&A experience and that will be able to kind of get us a return on investment sooner rather than later.
Great. I think that's great context and sets us up for the next question, which is much more tactical, which is what are family offices looking for in emerging managers? What differentiators about a fund really matter? And Nitu, I'd like to start with you. What are you really looking for? You talked a little bit about the qualitative and wanting to see GP investment thesis fit. Maybe you could walk us through when you're in a meeting and you've flown to meet an emerging fund, what are you looking for?
Yeah, so I'm, looking at the GP team to see like how well do they know each other, the trust that's between them. I think GP breakups in Fund 1 or between Fund 1 and Fund 2 is a real risk. We like to grow with the funds that we invest in. Like we want to come in, Fund 1 to Fund 3 and then come into subsequent funds. So that's one big point that we're looking for, that level of trust and communication. I think also as well, just speaking to their portfolio, how are they able to assist and help their portfolio go beyond what's required of them, and ask them how they're able to get deals. Like I think if their portfolio is like really going to bat for them and championing them, that means their founders are going to be recommending them to other founders. And I think founder recommendations go really far in the startup industry. So that's something we always try to do, is get referrals that way. And then I think I also love to ask, like in terms of diligence, like for a case study where we look at a couple of investments that are performing well and a couple of underperforming investments. My reason for including the underperforming investments, I think we've all made as investors like decisions that have turned out not how we would think. And I think especially in challenging macroeconomic environments, we want to have trust in our GPs that they will be able to survive challenging years and that they will be able to survive if there is like, a black swan event or something like that. We just want to make sure that the GPs are adaptable. So that's something that really matters to us. And we also want to know, when do they potentially abandon a portfolio company? What do they do when something is not going well? I think I've learned more in situations where a startup has been underperforming than when a startup has been overperforming. I'd say I'd like to round it out by saying, we like to just ask a lot of questions talking about their value systems. And I think that goes a long way to understand how their communication patterns are, how they deal with their portfolio, how they manage the growth of their own fund. And we also like to ask and look at future proofing. Future proofing means we like to say, what is your plan in the next 2 years, in the next 5 years, try to understand where they want the fund to end up. And make sure they're not just following any hype cycles blindly. I think there's like a joke that now in Silicon Valley, where I grew up, there's like so many new AI funds popping up, right? And I think, if you go back to 2-3 years ago, there were a lot of like Web3 funds. And I think we just want to make sure that the funds we're investing in go beyond any sort of hype cycle.
Mm-hmm. That's great. Winter, what do you think family offices are looking for in emerging managers? Anything else to add?
Yeah, it's hard for me to tease out what do family offices want and what do I want an emerging manager. I think in this market, experts, like to Nitu's point, right? Like again, like what's your edge and your advantage when you're coming to market? Especially, I think it was again when money was cheap, it was easier to get into business. But now that you don't have those market dynamics, like you really need to define your edge more clearly. And I think family offices specifically are looking for access. So, I mean, you have edge into a certain part of the ecosystem. They want to do co-investments, right? And they want to, have confidence that they're partnering with someone that is an expert in the opportunities that they're seeing on the back of, your legwork. There's definitely this concept around just long-term orientation, right? So, I mean, maybe a better way to characterize this is like persistence power of the GP, right? So, are you going to run out of money in 6 months? Are you going to run out of interest in 12 months, right? So what's your commitment to the asset class? I think you could take a flyer in kind of the market 2 years ago as an LP with a more diversified portfolio. It seems like it's less likely for a family office to do that in today's market when they have choices. So again, like you're convincing them on edge, you're convincing them of long-term orientation. And then lastly, maybe this is building on Nitu's point as well, which is just more like the financial skill set. Funnily enough, like with the Coolwater data, like we get a lot of application data into our accelerator, and there's a preponderance of founders, like people who have built tech companies who are coming to market and actually building investment firms now, much more than like spinouts. That's our data. Maybe other people are seeing it differently. But there's more people that have like gone through this founder journey as operators who are starting funds today. I think it was more mixed in the 2021 market where you had a lot of spinouts from investment firms. I think if you have that job today, you're probably trying to keep it versus like spin out and try to raise money in a tougher fundraising environment. But I think the irony there is like, even though there's more founders in the market today starting like doing fund formation, I think the financial skill set is overweighted by family offices, right? To this point of, how do you actually make money in venture capital? Is it through secondaries? It's through portfolio management. It's through kind of guiding your companies and really understanding like what's going to get that company to the next round, what's ultimately going to get that company to exit. I think, family offices seem to be overweighting that with through my conversations. I'm looking for more of like a financial skill set and ability to micromanage the company to success, or at least to the next round, which, it's hard to fundraise for emerging manager funds. It's hard to fundraise for portfolio companies now as well. So it seems like family offices are definitely overweighting those three things in this market.
Nic, what are you seeing? Are you seeing family offices overweighting financial skills? Are you seeing them? What are they gravitating to around emerging managers?
I think there's obviously a desire to sort of de-risk the I'm going to say heightened risk of an emerging manager, which, and Winter just made a really great point that I wanted to flesh out a little bit, which is there's a big difference between a first-time fund, so someone who's spinning out of a larger asset management shop and starting their own endeavor, versus a first-time manager who may have been an operator who now wants to raise their own venture vehicles. And there is advantages to both, and both have a place within a portfolio. But if you're looking at someone who's just dipping their toe into the venture water, they may want to go with a spin out or a first-time fund versus a first-time fund manager. And what they're typically looking at in both instances is really specialization and the edge that you have. And Nitu and Winter spoke about this as well. But as a GP, when you sit down with a potential portfolio company, you think about, why does this company need to exist, right? And I think family offices are no different. Why does this fund need to exist, and why do I, what's the edge and specialization they bring, and why do I need to be involved? So just a consideration to think about there, which the differentiation between first-time fund and first-time manager.
Mm-hmm. We're now going to go into, I think, the number one question that we got from attendees who wrote questions in advance, and we'll talk about this topic for the next 15 minutes or so, which is, how do you find family offices, and then how do you communicate with them? So I want to talk first about this, just simply, identifying family offices and building relationships. I think that it can feel somewhat opaque at times. Winter, I'd love to start with you. How would you recommend emerging managers approach the challenge of finding a family office and then finding the right family offices?
Yeah, I see a lot of people I know on the call probably giggling. This is like the time old question. Again, like there's never going to be a good answer for this, right? Like it is a lot of legwork. There is no cheat sheet for how to meet family offices. And, I worked for a multifamily office, right? Like a lot of them don't want to be found, right? Like they don't need you, like right? Like, so like, why are you so special? Again, it's that defining your edge, defining, your purpose to them, right? So again, it's not like, they're out looking to make like friends with emerging managers. That's not like a typical Thursday happy hour. So I think like I'm saying that because I think there's a perspective and kind of a mindset you need to be in. And I see different tactics, right? And strategies, like I'm going to go to this conference or that conference, like this family office pitch event or that family office pitch event. You do, I think from that perspective, a lot of people would say, don't go to those, but there are some good family offices that actually attend those. There are other people that go to those events that I think are less authentic sometimes. So you need to obviously kiss a lot of frogs, but that's true with any conference, right? So you can go to these family office conferences. Some are more or less expensive, but you are kind of investing into your network and building that network over time. And, what I'd recommend is like, do your pre-work, right? And this is just true advice for anyone that goes to any event, right? Like if you just show up and you're hoping to meet like all the right people, that's probably not a good strategy. If you, do the pre-work and the legwork to identify like who's attending this and who do I really want to meet, I think that's obviously like a good strategy, assuming you're starting from zero and you don't have any family office friends, right? I think the other strategy, and maybe this is tied to what I just mentioned in terms of like when you'd want to do it, in terms of timing, is just asking people, right? If you're starting a VC firm and you're asking for, $50 million, right? You probably, if at that quantum, like you probably know some folks that have done some interesting things. If you're in the technology ecosystem, you've probably been around for a while. Some people around you have probably been successful. They may have family offices or know someone that has family offices. So I'd say most family offices, they would answer this question as like, please get an intro, like a warm intro. But most VCs would answer that question the same way. Like, please give me a warm intro. Like if you randomly reach out to me on LinkedIn, I'm probably not going to respond to you. But if you get a warm intro via someone I know and trust, like that is a really good avenue into like meet and find family offices. You can get lists of family offices, right? There's a lot of those floating around. I probably have like 50 of them, but it's like, it doesn't matter. Like a list is a list. Like family offices are so heavily focused on the relationship, and they value that relationship, that if you're just pinging people randomly on a list, like you might actually lose points instead of gain points. And then your last question, which is around like communicating with family offices. Again, I think, because they value the relationship, right? Like they're like any other sophisticated LP, like they'll value the transparency of communication. And, they're trying to understand, again, like how you fit into their ecosystem or how you fit into their portfolio. So over communicating is probably better, right? Just because like their actions sometimes are, I don't need to meet you. Like, I don't need to be known. I'm a quiet family office. Doesn't mean like you should be quiet back. That probably means like, in order to build that trust, you should be over communicating with them in terms of, the process of fundraising, as well as like, once you're lucky enough to get an investment from them, the process of LP reporting.
Nic, what would you add to that? And have you seen any different ways of going about meeting family offices?
Yeah, I mean, I think what Winter said it was really interesting there, and it's the warm intro is certainly important, but another avenue that you could take is to develop a brand and a reputation in the industry itself and have the market come to you. When you think about your relationships, it's not just with the family office, it's with other GPs. They may be out of a fundraising cycle and they could refer clients to you through that. So, venture itself is obviously a pretty tight community, and you should be, and that comes to, sourcing deals itself. And you should be thinking about sourcing family office connections the same way. Another thing I would say is, don't just show up when you need the money. These relationships take a lot of time and trust to be built. They are going to be taking a risk on, going with an emerging manager. So you want to have them very comfortable with what your specialization, what your fund focus is. So just don't show up when you need that money. And it seems like it's going to take a long time, but it really just cuts down on future fundraising cycles. If they back you at the start, they're probably going to continue to back you through time. And the one thing I've noticed is that family offices love to help each other out. And they will absolutely refer you if they get to a level of comfort and have a great experience. And that goes to, transparency of your process, as Winter said as well, just being open, transparency, and authentic in those communications. I think you set yourself up pretty well. But it does take time. So why not be out on the leading edge and sort of be out there in the community, developing a brand and reputation.
Yeah, that's a good point, Nick. I think the idea of supernodes in the family office world is a true phenomenon. So if you can identify those, that's helpful.
And me too, I would love to hear from your perspective. How do you like to meet emerging managers? Are you going to the conferences? What does it take to build a relationship with you and your family office?
Yeah, sure. So we do go to a lot of industry events and conferences. Some that are targeted toward family offices, which have some managers attending, but some that are targeted toward venture capital. We usually go to IIE Connections Global Alts at the end of January in Miami. With intelligence, usually hosts a couple of venture capital summits throughout the year as well. And I think being part of several GP LP communities is also a good way to get to meet GPs for LPs. So Winter with Cool Water Capital, he has a great community of emerging manager GPs and hosts events and forums where LPs can attend. So I think there's some similar events to that we like going to. I would say capital intros from banks are less common for private equity and venture capital than they are for hedge funds. But we have gotten a few intros from big banks that way, such as, JP Morgan, Morgan Stanley, BTIG. They know our mandate, I guess, and what we're looking for in terms of fund size, and have sent us some managers. I've also gotten cold outreach, typically on LinkedIn, sometimes on Twitter. And, I try to I get an overwhelmingly amount of them, but I try to respond to them. I'd say warm introductions, like the other panelists mentioned, are a really good way, though. I think, having been in the direct investor track myself, I have a lot of friends who are investors who are now starting their own funds, or know people starting their own funds, and I have friends in the family office world and the allocator world who know that we're actively deploying in VC. So I get referrals from both investors and VCs, but also from fellow allocators and family offices.
Mm-hmm. And I'll just say, if anyone in the audience would like to ask a question, feel free to unmute yourself or put it in the chat. You're welcome to do that. Let's imagine the GP has developed a relationship with family offices. I want to look at what communication strategies are most effective, with the caveat that every family office investor probably has their own preferences. And Winter, you mentioned transparency. And Nito, I'd like to start with you, but do you want to be on the quarterly update mailing list for an emerging fund you've just met with? What do you find effective and what do you find not so effective?
I think immediately we kind of know whether this fund could potentially be an investment. There's been only a few instances where I've very immediately been yes, I think this will go, but I've definitely been an immediate no in several instances. So I think if I meet someone or a team who are GPs, I have a conversation with them, it goes well. and I, offer to give my email to continue the conversation or to be added to the newsletter, we genuinely do want to see the updates. I think in some situations, the track record just might be too little, and there might be no prior angel investment track history, no prior track history at a different fund. And in such a case, we really have to monitor and grow the relationship. But we do like the person, and we do think they have that edge. And in that case, and this has actually happened with our family office, we have built a relationship, monitored the updates, tracked how their co-investments are going, how their fund investments are going, looked at the deals they've warehoused in. And then in 18 months, sometimes 20 months, we've come in. Sometimes if it's an evergreen fund in the same fund, or sometimes when they're raising their fund too. So I'd say in a case like that, when we want updates, we indicate that, and we definitely read them.
Okay, great.
I would ask the question, like, does your family office know that you're a good investor? I think that's the right question to try to answer when you're developing your LP reporting. Does your family office know that you're a good investor? And if your LP reporting lacks, they don't know that you're a good investor, right? The other question maybe to ask is like, do you know, and this is like maybe even an existential question for you, but do you know your portfolio well? How well? And are you able to communicate that to your family office, right? If you can answer those questions, that's 95% of the battle with like good LP reporting. But I think what happens is when you're communicating with family offices, like you either don't know your portfolio well, or you don't have that ability to like, translate that into an effective reporting mechanism, quarterly letter, newsletter, monthly, whatever. So I just try to keep it simple, because like, you can build very complex reporting, but I don't think that's like where you should start. Like you should start with just like, I need to translate the great investments I'm getting access to and investing into to my family office, and try to be as transparent as possible about that. And I think that exercise alone is incredibly important, because if you can't articulate like what you're investing into, why you're investing into it, how it's performing, then you have to ask yourself that existential question of like, am I a good VC? Am I a good investor? Am I acting with the right fiduciary responsibility that I was entrusted with this capital? Right. So I think like, again, like I'm not trying to scare people. I'm just trying to say like, those are probably the right questions, fundamental questions to ask. And that will level up your LP reporting, right? Like it'll force you to be better at really understanding kind of like why you're an investor and what you're invested into. And that's what you want to know, right? Like that's what family offices want to know. How are your portfolio companies performing? And when you translate that well, I hear back channel from family offices about them getting more excited about that manager.
Victoria, you raised your hand. Feel free to unmute yourself and ask a question.
Hi, Victoria here. Just to follow up on that question, I'm curious when you say, like, you talked a lot about the LP reporting. I think that's great. But how do you think about that in terms of when it's a potential LP, so you wouldn't normally share all of that information? How has a previous manager you haven't invested in yet adequately showed you that before you actually invested? Particularly one like who's an emerging manager, like first time manager.
Yeah, Victoria, I think that's a great question. What should you report on when you're just in the getting to know you phase, Winter? What would you say?
The question is what should you report to the family office when they're getting to know you?
Yes.
Yeah, it's just like because you mentioned those like specific reports, which I think are great for like your LP reporting, but because they aren't an LP yet, they wouldn't have access to that. So how do you still convey that information without being able to give as much transparency as you would?
Thank you for the question. I think I would suggest like a shift in mindset, where if you're asking someone to give you $5 million or $1 million or 500K, right? That is a lot of money. And what would you want to know to give $1 million to someone, right? You probably would be okay, like seeing their LP reporting, right? So I think just thinking about it that way, where it's like, wow, these people are putting me into business. It's their money. They really want to know, right? Like they're giving you capital to invest over the next few years, and it's locked up for, 7 to 15 years. That's how I think about it, just in terms of like the level of transparency. So I wouldn't necessarily say there's a difference in kind of like what you're sharing. Again, it's a process of building trust. So you don't necessarily, right? That's your judgment call to say like, I'm going to share everything on day zero before I've even had the conversation. But if you've had a couple of conversations, you feel confident in the relationship, it's okay to share, again, it's your call. It's okay to share kind of what you're reporting to your existing LPs to get that prospective LP like interested in what you've done, right? Again, like how does your family office know you're a good investor, right? If you don't share your LP reporting and they can't see the underlying assets and how they're performing, like it's going to be hard for them to get to the decision. So then the question you have to ask yourself is like, what's the downside of me reporting what I'm already reporting to my existing LPs? It's not like a consistent reporting. You don't have to put them on your listserv forever. Like that is kind of restrictive for your existing LPs. But when you're in the fundraising process and in the trust building process, like you may want to think about just like sharing that information, given the quantum of investment size that family offices can present for emerging managers.
Caroline, feel free to unmute and ask your question.
Hi, great. Thank you so much for hosting this. My name is Caroline Lewis. I'm with Rogue Women. Curious, and for anybody on the panelist, one of the things we set up was the ability for individual family office, high net worth to invest directly via DAF or via charitable contribution. Curious for anybody who's working with family offices, how they've seen family offices think about whether it should be through a DAF, charitable contribution, or an investment. Part of the reason we did it was for the tax advantage for some of our family offices. So really curious of what you guys have seen in that space, if anything.
I think we considered that structure a few years ago, a little bit before my time. But ultimately, we wanted to build out a practice that was doing significant venture capital investments. And we wanted to build it out to be almost as big as the hedge fund side with a focus on profitability. And because of that, we're not doing a DAF for venture capital. We're still exploring potential if we want to set one up for maybe impact investing or impact investments or things down the road, or if we want to have a separate philanthropy division or something like that. But for us, it was I guess the more pressing issue was we wanted to build out a team and hire a team and have the function kind of mirror what we had built on the public equity side. So we saw the tax benefits, but we ended up not pursuing it.
Nic, anything you've seen on the DAF front?
Yeah, no, nothing to add to that.
Okay, great. Well, I'm going to ask the question of all of our panelists, and Nic, I'll start with you. What is the number one mistake you see emerging managers make when speaking with family offices?
It's a really great question, and I think it goes back to really understanding where they're at with their allocations in general, how much they actually understand the venture space in and of itself. Expectations really need to be set up front, and you being a guide to them in the specialization and area of venture that you are focused on will help do that. And going back to the earlier discussion, like being transparent about your process and what you're doing really helps set those expectations up front, because you don't want to get to the point where you've delivered a 10x return for a family, you haven't been transparent, you haven't taken the time to get to know them, and they don't understand how you got to your return. So the next fund they decide to opt out. I think that's really, really important, and you can't underestimate how important that is to them. Like these are families that have taken great risk in the business they've built and the way that they've built their wealth. These are people that could be great partners to you. So not understanding that dynamic and really capitalizing on it is a missed opportunity for you, but also potentially sets you up to have for those family offices to have a bad experience with their investment. So be consistent, be transparent, and view this as what it is, which is a multi-decade partnership with families that want to support you, that want to back you, that want to take the risk, and that want that exposure. So yeah, don't take it for granted.
Great. Winter, go ahead. What's the number one mistake that emerging managers make when communicating with family offices?
Two ears, one mouth.
Meaning you should
think-
listen and not speak so much, or the opposite?
Yeah. There's so many people that engage with me and they start the call with like 20 minutes of just pitching.
Great.
And then you run out of time.
Need to, any mistake you see coming your way?
I think just understanding the nuances and timing. I think unless there is a significant advantage to coming into a first close or second close with LP terms, a lot of family offices in this market are waiting, until some of the final closes, especially if it's a new relationship. And especially if they haven't done that much venture. I mean, my background is venture capital. We've been allocating into venture. We know the sector and space and asset class pretty well. But I would say there are several family offices that are starting to dabble into venture or have only been doing venture for the past couple of years. And this is their first venture down market. I think because of that, there is a bit of fear around the illiquidity of venture and about what's going on in the economic climate. So to that note, it's going to be difficult to kind of push the family offices in these positions to coming into a first close or to doing rapid diligence. And I think just being aware of building a long-term relationship, planning for the allocations to be not sooner rather than later, I think is important. A lot of folks I meet, emerging managers and just general managers, think we'll meet a few times and then I'll be signing a check and we'll be signing a check in like a month or two. And that has happened a few times, but that's not the norm. And I think just being aware of that is important. And like Winter said, listening, learning, being open to feedback is important.
Okay, so what we heard you all say is make sure the family office really understands what you're doing. Don't just assume they understand your investment thesis based on one explanation. Listen and ask questions more than you talk. And then finally, understand that unless there's a real need to get into the first close that the family office feels, they're really considering their own timing versus the timing that you might have laid out. We have reserved the next 20 minutes for breakout rooms so that you all can ask. I see a lot of questions, but before we go into the breakout rooms, we have two questions about events. So can I ask each of the panelists to share their favorite family office events? Nitu, you mentioned a couple. I'll make a list and share it back out with everyone. But if you could think about what events have mattered to you, Nic, what are a couple events that you would share are worth attending?
Well, obviously the Allocate innovation field trips, which we do every quarter or so, are great, but Raise is a good event for sure, which we had back in October of this year. So one that definitely you guys should have on your radar.
Great. Winter, any of must-go events?
I guess I have to go to the Allocate event. Thank you, Nic, for the invitation.
Have one now.
Annual meetings, right? Like, do you have friends that are emerging managers? And are they hosting annual meetings? Like, those could be good events to go to. The Cool Water demo days, obviously. Nic, I'll send a invite, vice versa. Obviously, Raise is good. It's kind of like the who's who. So if you can get in and go, there's a lot of active allocators into emerging managers that are there. And then there's just a whole host of other events, right? Like the folks on this call, Raise, like those are kind of the in-crowd events. And then, yeah, there's like the iConnections ones in Miami, but there's a whole host of other events there, right? Art Basel, hopefully people were hanging out in Miami last week, right? Like that's a good one. There's the ones kind of that are a little bit like, you wouldn't think Art Basel is like a a conference per se. It's not like a super return, but it is, right? Like if you're aligning with like 2 ears, 1 mouth, like if you're aligning with what people care about, right? They care about art, right? Go to what they care about. Like that's probably a better strategy than like going to the middle of the fairway event. That's like, you know, an LPGP conference. So it kind of is dependent on, again, what you heard and what do they like? Do they like crypto? Do they like industrials? Do they like art? You know, do they like something else? Like that's probably how you want to like, you know, shape your calendar.
Great. Well, we will go into breakout rooms, so stay on, please, if you'd like to participate. Nic, Winter, and Nitu will each moderate one, and I also hope this is an opportunity for you all to meet each other. So I'm going to assign this. Bear with me while I do this, so might be a 30-second pause.